Stock prices change every second because buyers and sellers are constantly negotiating. There isn't a secret Wall Street team setting prices. It's just real people trading. Think of the stock market like a busy marketplace where thousands of small decisions happen at once. Each buyer wants the lowest price. Each seller wants the highest price. When they finally agree on a number, that agreement becomes a new market price. The price you see on your app is simply the price of the last trade. It might not be the price you get, because prices move constantly. Once you understand this basic idea, investing feels much less confusing. Every stock price comes from two sides: people who want to buy and people who want to sell. Buyers try to pay the lowest amount, while sellers aim for the highest amount. These two forces push against each other, creating constant movement in prices. When a buyer raises their offer, the price moves up. When a seller lowers their price, the market moves down. Nothing about this process is hidden. It all happens openly through the order book. The market price is simply the point where both sides agree, even for just a moment. And that agreement changes all day long, which is why prices never stay still. The order book is a live list, showing every price buyers want to pay and every price sellers want to accept. Buyers place bids, and these bids stack up from lowest to higher prices. Sellers place asks, stacking from higher prices down to lower ones. The gap between the highest bid and the lowest ask is called the spread. When a buyer agrees to the seller's ask, a trade happens instantly. And when a seller accepts the buyer's bid, the price updates again. This constant matching of bids and asks is what makes markets feel alive. Understanding the order book helps you see why no price ever stays still for long. Prices rise when buyers become more aggressive and start offering higher amounts. This often happens after good news, strong earnings, or positive market sentiment. Prices fall when sellers get nervous and lower their asks to exit quickly. This usually happens when bad news hits, or when fear spreads through the market. Short-term price swings are mostly emotional, not logical, and not based on real value. That's why beginner investors should avoid judging a company by a single day of movement. Long-term value comes from the business, while short-term noise comes from human reactions. When you separate emotion from value, investing becomes much clearer and safer. Short-term prices jump around, but real value comes from the company's long-term performance. Intrinsic value is the estimate of what a business is truly worth, based on its profits and future potential. This value doesn't change quickly because real businesses don't transform overnight. To find intrinsic value, investors look at earnings, growth, assets, and long-term stability. Two investors may calculate different values because every estimate uses different assumptions. Intrinsic value is not a perfect number, but it helps investors avoid emotional decisions. When the market price is below intrinsic value, long-term investors often see opportunity. And when the price is far above it, investors become more cautious and selective. One popular method is the discounted cash flow model, where investors forecast future cash and bring it back to today's value. DCF helps measure how much money a business might generate over many years ahead. Another method focuses on dividends, valuing a company based on the payments it returns to shareholders. This approach works best for stable companies, with predictable and steady dividend payouts. Some investors use asset-based valuation, looking at what the company owns minus what it owes. This method is common for real estate firms or businesses with large physical assets. A simpler way is using valuation multiples, like the PE ratio, to compare similar companies. A simpler way is using valuation multiples, like the PE ratio, to compare similar companies. Value investors look for companies that trade below their intrinsic value and hold them for the long run. This strategy focuses on patience, buying strong businesses when they're temporarily overlooked. On the other hand, growth investors buy companies with big future potential, even if today's price looks high. Tech companies often fall into this category because people are betting on rapid innovation. A stock can trade far above intrinsic value if investors believe the future will be much brighter. But if expectations drop, even slightly, these high-growth stocks can fall quickly. That's why understanding market psychology is just as important as understanding financial numbers. The goal is to balance long-term value with future potential, without getting carried away by hype. Market prices are influenced by more than numbers. Emotions and expectations play a huge role. When investors expect strong growth, prices can rise far above a company's current results. Low interest rates can also push stocks higher, because investors search for better returns. But when rates rise or confidence drops, the same stocks can fall quickly. The market often ignores intrinsic value for long periods, especially during hype or fear cycles. That's why long-term investors focus on fundamentals, not short-term noise. In my experience, the biggest mistake beginners make is chasing quick wins instead of building long-term habits. The investors who succeed are usually the ones who stay calm and stick to a simple strategy they understand. So remember, markets move, emotions shift, but solid investing comes from patience and knowledge. If this video helped you, please like, subscribe, and support the channel so we can keep creating more helpful content.